Hey there, are you struggling to grasp the concepts of debits and credits, the double entry system or T accounts? Do modern learning tricks like DC ADE LER or DEALEAR just aren't sticking? If so, you are in the right place. In this video, I'll be breaking down the 3 golden rules of accounting, which are based on the principles of double entry bookkeeping made famous by Luca Pacioli, often celebrated as the father of accounting. Understanding these rules can help clarify the sometimes confusing modern mnemonic aids. Remember, we all learn in different ways, and what clicks for one person might not click for another. That's why I'm excited to walk you through these classic golden rules. They provide a straightforward approach to mastering the double entry system. So let's dive in and make sense of these essential accounting principles together. The 3 golden rules of accounting refer to how debits and credits are applied across different types of accounts in the double entry system. Each rule applies to a specific type of account: personal, real, or nominal. These rules provide a framework that divides accounts into 3 distinct types. This classification simplifies the process of recording and analyzing financial transactions, ensuring each entry is placed in the correct category. Let's explore each of these accounts types in detail. First, we have personal accounts. These accounts relate to individuals, firms, companies, and other entities. In essence, personal accounts represent people or organizations that your business interacts with. They can be further classified into natural persons like James Smith, artificial persons like XYZ Corporation, and representative persons like outstanding salary accounts. Here's an example. If your business buys goods from a vendor on credit, the vendor's account in your books is a personal account. Then we have real accounts. Real accounts pertain to assets and properties of a business. They do not get closed at the end of an accounting year. Instead, their balances are carried over to the next accounting period. Real accounts can include tangible assets like cash, machinery, buildings, or intangible assets like patents and trademarks. Here's an example. When you buy equipment for your business, the transaction affects the equipment account, a real account, showing an increase in business assets. And the third category is nominal accounts. These accounts are related to income, expenses, gains, and losses, transactions that affect the net income of a business. Nominal accounts are closed at the end of the accounting period, and their balances are transferred to the income statement to calculate the net profit or loss for the period. For example, salary expenses or service revenue are recorded in nominal accounts. At the end of the accounting period, the total salaries or revenue will be transferred to the profit and loss account. With these categories in mind, let's delve into how the 3 golden rules apply to each, making sure every transaction is accounted for in just the right way. The first golden rule applies to personal accounts, and the rule is: debit the receiver, credit the giver. This rule applies to personal accounts, which involve individuals, firms, or other entities. It focuses on the direction of the transaction, whether someone is giving to or receiving from the business. It's all about the interactions between your business and other people or entities. For example, your business borrows $10,000 from a bank. First, we determine which rule applies. The bank is an entity, so we determined it is a personal account, and we need to apply rule number 1. Then we determined who is doing the giving and who is doing the receiving. So let's take a look. The bank is providing funds to your business. Therefore, the bank is the giver. According to the first golden rule of accounting for personal accounts, debit the receiver, credit the giver. The giver of funds in a transaction should have their account credited. Now, it's essential to clarify here that in this scenario, the bank's account being referred to is not the bank's own account on their books, but rather the bank loan account on your business books. Your business is receiving $10,000 in cash from the bank. In accounting, your business is the receiver of the funds. Following the same rule, debit the receiver, credit the giver, the receiver in a transaction should have their account debited. Therefore, you would debit the cash account in your company's books to reflect the receipt of money. So the journal entry in your business accounting records for this transaction would look like this. Debit the cash account for $10,000. This increases the assets because cash is coming in. And you credit the bank loan account for $10,000. This increases your business's liabilities because this represents money that the business now owes to the bank. This transaction increases both the assets, cash, and the liabilities, the bank loan, of your business, keeping the accounting equation balanced. It reflects an inflow of cash, which is an asset, and a liability as the borrowed amount that needs to be repaid. The second golden rule applies to real accounts. Debit what comes in, credit what goes out. Real accounts are related to assets, both tangible and intangible. This rule tracks the movement of assets in and out of the business. For example, your business purchases a piece of machinery for $5,000. Let's break down this example to better understand how the transaction is recorded using the second golden rule of accounting, which is debit what comes in, credit what goes out, which applies to real accounts. The machinery, an asset, is coming into the business. According to the rule for real accounts, you should debit the account that represents what is coming in. In this case, that's the machinery account. To pay for the machinery, your business uses $5,000 in cash. Cash, also an asset, is going out of the business. Following the same rule for real accounts, you should credit the account that represents what is going out. This transaction decreases the cash account balance in your books, reflecting the outflow of money. So here is the journal entry. You debit the machinery account for $5,000, which increases the asset, and you credit your cash account for $5,000, which also decreases an asset, keeping your accounting equation balanced. And the third and final rule is, for nominal accounts, debit all expenses and losses, credit all incomes and gains. Nominal accounts, again, deal with income, expenses, gains, and losses. This rule ensures that increases in earnings are credited and expenditures are debited. For example, your business receives $2,000 for services rendered. Let's clarify this example by explaining how the transactions are recorded under the third golden rule of accounting. Debit all expenses and losses. Credit all incomes and gains. And again, this rule is for nominal accounts. When your business performs services and receives payment, this represents an income. Since the transaction involves earning income, the service income account needs to be credited. Additionally, since cash is being received and cash is an asset, although not governed directly by the third golden rule, but rather by the real account rule, debit what comes in, the cash account is debited. This increases the asset account, reflecting the receipt of money. So here is your journal entry. You debit your cash account for $2,000 and you credit your service income account for $2,000. So in summary, today we've covered the essential framework of the three golden rules of accounting, which are instrumental in the double entry bookkeeping system. Each rule targets a specific type of account: personal, real, and nominal. And it helps ensure that every financial transaction is recorded accurately and effectively. And that's it for today's video on the three golden rules of accounting. If you found this helpful, don't forget to like and subscribe for more finance and accounting tips. Thank you for watching. See you next time.